few months ago, investors were obsessed with the relationship between Germany and Greece. Today, German MPs signed off an €86 billion rescue package for Greece, avoiding default and the possible Grexit that everyone used to be so worried about. But markets barely even noticed. Focus now is almost entirely on China and the Federal Reserve, and just how bad things could get for commodities and emerging markets as a result. Now, there's the occasional other thing of note going on that we should look at. One seems to be the fall from fashion of share buybacks. It isn't that companies have stopped buying their own shares. In fact, quite the contrary. According to Barinyi Associates, announcements of buybacks reached new highs this year in the US, above $500 billion, and actual purchases have carried on apace. But investors are no longer so enamoured of the idea of companies handing back cash through buybacks. This red line here shows the relative performance of the S&P 500 buyback index, which tracks the 100 companies doing the largest proportion of buybacks compared to their overall value. Now, it had been an absolutely wonderful performer over the past few years, particularly since 2013. You can see its outperformance really was quite dramatic here, up until late February. Now, that was what was going on during that period was investors were cheering the idea of companies being some of the biggest buyers of their own stock. But since February, the measures really struggled and lagged behind the broader index. You can see that's come down and has come down even more sharply in the past couple of weeks. Now, one reason is the construction of the index itself. The biggest difference between the buyback index and the S&P 500 is the small size of holdings in the very biggest companies. That's the result of the buyback index being equal weighted, while the S&P gives more importance to companies that are worth more. It's market cap weighted in the jargon. Now, to try to overcome that, what I've actually put here is the relative performance of the buyback index against an equal weighted S&P 500. So it should eliminate some of that size distortion. Still, the recent underperformance coincides with something else too, a recovery in the safer dividend stocks. I've got one measure of that here in blue, and you can see that recovery coming up there. And what this looks at is the S&P 500 dividend aristocrats. That's companies which have paid an unbroken dividend for a quarter of a century. There's a partial relationship between dividends and yields, it has to be said, bond yields that is, with the 10-year US bond yield on here in green. Now, as bond yields rise, that is, bonds themselves sell off, then shares that are bought for their dividends are also likely to sell off. So rising bond yields ought to mean underperformance of dividend stocks. And as you can see, it absolutely has. The green and blue lines here, broadly speaking, move in opposite directions, and it's even more obvious back in 2010, 2011. So, in other words, dividend shares underperform when bond yields are rising and outperform, the blue line goes up, when bond yields are falling. Now, this matters somewhat for buybacks as well. Buybacks come with no implications of future payouts, unlike dividends, even though they might have been going on for a very long time. They also come from companies whose revenues are rising more slowly than the market, where analysts expect no earnings expansion over the next year, according to analysis by Robert Schwab of Stahl Research. It isn't just that these are companies with little top-line growth which manage to cut their way to profit. Companies are increasing debt to finance the buybacks, taking advantage of low borrowing costs. That appeals to investors a lot when they feel good about the world, and they broadly were when during this era, when the European problems seemed to be behind us, at least temporarily, and low borrowing costs and the adjustment to a world of slow but steady growth with low interest rates meant that you could kind of bet on a zombified outcome. That is, you wanted to buy companies that were able to borrow cheaply and pay you back. But when they're worried, investors would rather have the security of a steady dividend paid from a solid business. That is, they want to buy these sorts of stocks. Now, unpicking the precise contribution of each of these elements to what's going on with buybacks is impossible. And perhaps the companies in the buyback index would have done even worse if they'd hung on to their cash instead or invested it rather than doing those buybacks. But it does seem that buybacks are no longer such an easy way to prop up share prices as they were. The question now is, will this underperformance continue, and how will investors adjust to the new world?